Hello accounting scholars, I'm Dr. Baldwin and this is demonstration video 1A. So what we're going to do here is we're going to look at an example problem, an example exercise, which you should work before you watch the video, and then I'm going to solve it in a video. So you need to have tried it yourself first. If you just sit and watch me work it, it's not going to really help you learn. You need to attempt it first. This first video is just going to be parts A through D. So let's look at the question. This is about TEL Translation Services. It was started at the beginning of the month of May. It incurred some transactions, so some things happened. So I've got a nice long list of transactions at the top half of the PDF you're looking at. So you've printed off the PDF, which was the one line above this video in Blackboard, and you've worked the problem. Hopefully at least the first 4 parts, A, B, C, D. All right, we're going to do A, B, C, and D in this video. So if you haven't done them, stop the video, go back, print it out, work A, B, C, and D first. Now, if you've done that already, let's proceed. Let's do A and B first. A says simply, create a table to show the effects of transactions. Use the following accounts. Got a nice long list of accounts there. And then it says label the accounts as appropriate. So we have a set that's assets, a set that's liabilities, and a set that is equity. All right, so that's what we're going to do on the next slide. So here we have our labels. So write them out. You're going to have a column for date and a column for cash, accounts receivable. Note how we have abbreviated that. It's very common to abbreviate it like that. And equipment. So those are all of our assets. They have a big heading. Then we have just one column for liabilities, because the only one we have is accounts payable. That's a current liability. And then we have a bunch of equity accounts. We've spread out our equity into 4 different accounts here. This is how we're learning. We won't be doing this forever, but we're doing it in chapter 1. We've got our common stock. Then we have our dividends, and the minus sign reminds us that dividends decrease equity. Common stock obviously increases it. Dividends decrease it. Revenues increase it, so there's a plus, and then expenses decrease it. So all of our expenses will go in the expense column. Every time we have an increase or decrease in cash, it'll go in the cash column, and so on and so forth. Now I've underlined them, which is a good idea for you to do as your handwriting, because it'll help you see your columns to keep straight. For me, that's the hardest thing to do in handwriting, is to keep them straight. So I'm not handwriting here, don't have the ability to do that on the technology today, so I'm doing it this way. Record the effects of the transactions in the accounting equation accounts by recording increases and decreases in appropriate columns. So I'm going to go back up here and remind you, we have assets equals liabilities plus equity. Right? That's the accounting equation. That's the one we've got burned into our brain. So first transaction, let's read it. On May 1st, the owner invested $50,000 in the company in exchange for common stock. So let's think about what's happening here. So $50,000, that's cash, that's coming into the company, so that's an increase in cash. We're going to record an increase in cash, and it's an exchange for common stock. So we're going to record an increase in common stock. So what is that going to look like on our worksheet? It's going to look like this. We're showing $50,000 going into cash. It's a positive number, okay? And we're showing $50,000 in common stock. And we put the date, which was May, I believe, 1st. All right? Is our accounting equation in balance? We've got $50,000 on one side and $50,000 on the other side. It sure is. You could actually stop and do the math after each transaction if you want to be sure. I'm not going to do that here, but obviously you better eyeball it to make sure you're keeping it straight. Let's go on to the next one. On May 3rd, the company rented office space for the month for $1,000 cash. So what happened to cash? Cash went out. Cash is being decreased. Why? Because we want to rent some space. So that's going to be rental expense or rent expense. So I'm showing cash decreasing, right? Why do I have the parentheses? That's a negative number in accounting. Parentheses means it's negative. And I'm showing expenses. Expenses aren't decreasing, but it's a decrease in equity, all right? So I'm showing it as the negative that it is on equity, okay? Next one. On May 5th, the company purchased equipment costing $1,500 on account. So we're going to get equipment. That's a kind of asset $1,500 worth, so we're going to increase equipment by $1,500, and it says on account. What does that mean? That means we're going to pay for it later, but not very long later. So that means we're going to give a liability. We're creating a liability here. So we're going to show $1,500 increase in equipment and $1,500 increase in our accounts payable. That's our short-term liability that we will pay off in the near future. Look at May 6th. The company paid $500 cash for advertising its services locally. So what are you going to do with that? Cash coming in, cash going out. Well, it's paid. That means it's going out. So a decrease in cash. And what's it for? It's for advertising expense. So how are you going to record that? We're going to record that by a decrease in cash and a decrease in expenses. All right? Expenses, remember, have a negative impact, a decreasing effect on equity. Let's look at the next one. On the 9th, the company purchased equipment for $1,200 cash. So we're spending cash in exchange for equipment. We're giving up one asset in order to have another. So over here, we go to our cash column. We're showing $1,200 decrease. That's the cash going out. And we're showing the fact that we bought equipment worth $1,200. So we're increasing one asset, decreasing another. Giving up one asset in exchange for the other. Now, if I go too fast here for you, if you're slower at writing or you need to make some changes, just hit the pause button. Or you can even back up. There's a little line where you can back it up to wherever you want to be. May 11th. The company received cash of $2,700 for services performed for ALM Partners. So we performed some translation services for this company, and they paid us $2,700. So here's our cash coming in, right? Cash is increasing. They gave us cash, and we're recording our first revenues. Awesome. We're making some revenues now, so we're recording our first revenues. You'll notice that not every number I've written on here has a dollar sign. So I put a dollar sign here because it's the first number in that column. You'll notice over here in cash, I put a dollar sign on the first one, but I haven't bothered to put a dollar sign on the rest. And I won't until I need to do some math, until I need to calculate a total. The dollar sign at the top of a column of numbers on which you're going to do math tells everybody that everything in that column is dollars. So we've recorded our first revenue. On the 14th, we completed another service, a $3,600 service for Bartlett Inc. on account. So they haven't given us the cash yet. We've done the work, so they're going to owe us. So we're going to record the revenue, but they haven't given us the cash. We're going to record the fact that they owe it to us. So we're going to record the revenue. That's pretty easy to do since we just did it right here, $3,600. But now we're going to record an account receivable because that customer owes us $3,600. Now, I'm sure we've made some kind of agreement. You have to pay in X number of days, right? We won't worry about the details here. We're trying to get the big picture. So we recorded the revenues coming in, and we recorded an asset. Accounts receivable is a short-term asset. It will be converted into cash eventually because they'll have to pay it pretty soon. Let's look at the next one. On the 16th, the company paid $1,500 cash for the previously purchased equipment. So we bought some equipment up here on the 5th. The company purchased equipment costing $1,500. On the 16th, we paid that liability off. We paid the whole thing, all $1,500 on the 16th. So here's the cash going out. That's pretty easy. All right, any transaction that involves cash, think about the cash part first. So we're decreasing cash by $1,500 in order to pay off a debt, a liability known as accounts payable of $1,500. On the 19th, the company received cash of $3,600 from Bartlett as payment on account. So this is a company that we did work for. They haven't paid us yet. We already recorded the revenue and recorded the fact that they owe us, but now they're actually sending us the money. So here's the money coming in, $3,600, and then we're removing that $3,600 account receivable. They don't owe us anymore because they sent us the money. On the 22nd, we paid a utility bill with $200 cash. Pay the utility bill. $200 going out of cash, right? Negative, decrease. $200 in utility expense. On the 26th, the company completed a $500 service for Cervez Company on account. So we're going to record $500 of revenue. We've earned the revenue. We haven't got the cash yet because it's on account. So we're billing them. They're going to pay us in a short period of time. So we have revenues, another $500 here, and we have accounts receivable, $500 here. So we have now we had an account receivable from one customer, which they paid off. Now we have another customer. We've created an account receivable. That's a short-term asset. On the 28th, the company paid cash dividends of $2,500 to the owner. That's a distribution to the owner. So we're showing cash going out of $2,500, and then we're showing over here under equities dividends, which is a decrease in equity, so we're showing it as a negative number, dividends of $2,500, showing it as a negative. Notice we're still in balance, right? If we take $2,500 off one side of the accounting equation and take $2,500 off the other side of the accounting equation, we're in balance. And the last one, the company paid the receptionist $800 cash for the month's salary. So we've got cash going out, so here's our decrease in cash, and recording salaries expense. So we have all of our transactions recorded, all of our transactions for the month. So all we really need to do, add up the accounts. What are we doing? We're determining the balances. So all we do here is we add them up, all right? Positive numbers, subtract the negative numbers, add the positive numbers, subtract the negative numbers. You can see how easy this would be to do in a spreadsheet. We're not bothering to get you to do it in a spreadsheet because eventually we're going to be doing it in a different way. This is just the way we're learning. Okay, so you can add them up with your calculator, add them up with your brain is even better. Most of these you ought to be able to do with your brain. You'll notice that our accounts payable balance is 0. All right, we don't have anything there. But you can see we have balances in all the other accounts. Now here's a question. Do assets equal liabilities plus owner's equity? We'll add them up and see. If they don't, we've got a problem. Okay, got a big problem. So add them up and see. Now, take those balances and prepare the financial statements. You go do it and then watch the next video, which is going to be Demo 1B.